Hello, everyone. Can you hear me? Okay. Um, I think it's time to start. Let me share my screen. You can see my screen, right?
Yes.
Okay. Welcome to the financial literacy course. My name is Sofia, or Sonia, as you're more comfortable with. Let's start. I'll start with the introduction, and this is a 30-hour course, which assumes 80 hours and 18 hours in class and 12 hours for homeworks. Here is my contact information. You can see my email and my Telegram. You can choose any of them to ask questions or to communicate on any topics you prefer. Okay. So why everyone should learn finance? First of all, I think it allows us to be aware of all opportunities we have on the market. It's not always obvious, uh, and there are many of them. So also we need to study financial literacy because it allows us to estimate risks of those opportunities, because sometimes if you don't understand what you're doing, you can lose everything, for example, and we should always account for that. So also financial literacy would allow us to plan personal budget more reasonably. It's also important to understand what's going on in the world. When you read news, for example, sometimes you may not understand what all those words means, how to analyze this context. And also, when I asked you to fill in their questionnaire in Telegram chart, I noticed that many people are interested in investment, and that's actually what would I probably expect. But I cannot imagine actually how can anyone invest without understanding of the economical context and without being able to follow what's going on in the world, in politics, in economics, in finance, without ability to read news and so on. So I think this part is also very important. And of course, today with all the internet and all the innovations and gadgets, financial frauds become more and more sophisticated. So we will talk about this part too. Okay. By the way, if you have any questions during any part of the lecture, please interrupt me anytime you want. You can as well type something in the chart or just use your microphone to ask question and discuss anything. Okay. This is about the structure of the course. As I said, we're going to have six classes of 3 hours. Tuesday, Wednesday, and Thursday, this week and the next week. So our last class is going to be, I guess, January 21st. You're going to have 5 small, like really small home assignments. And the last class is planned for the student presentations of different financial phenomena or historical events important for financial world. Also, there is a requirement of the education office of the 80% attendance. So in our case, it means you can skip only one class. And also, as I said, this course counts in total as 30 hours. Okay, now a little bit about the course structure. The first class, I hope we will be in time, and I hope it will be only the first class, but maybe a little bit longer. We will talk about the financial system structure, mainly about the different types of financial institution and financial market players, about the political government of finance, and about some macroeconomics basics like GDP, interest rates, exchange rates, and we will constantly be considering some examples from the media. On the next topic, we will discuss standard banking products. Maybe some of you will find this topic easy, but I think it will be still useful to discuss those things. Okay, and class number three of everyday finance. That's how I decided to call it, because it's just actually a set of different life hacks and useful things, and something we could use every day. It does not much requires any like super special knowledge about finance. So maybe if we won't be in time, maybe I'll just skip it, because I know that many people are interested in investment, and I would not want uh, to skip some part of the investment. So I wanted to be in a full amount. And the last class, as I said, we will devote to the presentation of some economical phenomena. Can talk about it more. And I also uploaded a file in Canvas. It's called About the Course. And here are some more information and examples of, for example, what can you be discuss, what can you be presenting in this class. Okay, and here is a slide about some course expectation management. I did it just in case, so no one would be disappointed, or you have time to switch if you expected something else. So first of all, I want to say that to emphasize that we will talk about financial markets and about the economics, and every market is different. And I understand that we have international students here, or maybe someone who is willing to, for example, live abroad and go work abroad. But since every market is different, we cannot probably discuss everything. So most of the country-specific examples will be of Russia. Maybe sometimes about the United States, because United States is like the most well-studied and well-developed financial system, or probably one of the most. So, but if you know something about your country examples, you please talk, tell us about it, and it's always interesting to discuss different examples. Also, I already sent the questionnaire form in the Telegram chat, but also please understand that it's not possible, of course, to cover every aspect of every topic in such a short time. And if you have any specific topics that you're most interested in, please tell me you can either fill this questionnaire form, which is anonymous, or you can just write directly to me. And I still have some part of the course on, it's possible to adjust it. So I'll try to include the topic which are most interesting to you, if they're not there yet. And the last 2 points I added just in case, I don't think many of you expect something like this, but just in case if there are people who expect some secret secret knowledge, how to become rich, since this is a course about finance. So probably in some way it would be reasonable to say, okay, I'll come to this course and maybe we'll discuss some secret ways how to get rich like in short time. Unfortunately, there is no such secret way so far. I would be happy to know it as well. And also we will discuss some probably examples of different types of investments and so on. And I want to emphasize that every person has a different situation, and there is no universal, there could be no universal advice, what we should invest into, because for everybody, it's probably its own requirements, his or her own requirements, and it should be managed in an individual way. So please do not consider anything we will discuss as a direct recommendation. Okay. Any questions on this point? Okay, good. Then let me share my next presentation. You can see my presentation now, right?
Yes.
Okay.
Yes.
Thank you. Okay, so today, as I already mentioned shortly, we're going to talk about basics of the financial system. First, we will talk about the types of different financial market participants and institutions, like banks, probably the most popular, and other types. Then we will also discuss some basic macroeconomic terms as exchange rates, currencies, interest rates, and we will be constantly considering some different examples from mass media when you see some title, just so we could understand what it means, and hopefully to analyze media by self. Okay. So what's generally what's financial system? Actually, I just found this definition, almost this definition in Wikipedia, and I consider it quite feeling. So what's financial system? Financial system is actually a system which allows to exchange of money, goods, different assets between financial market participants. There are three major financial market participants. They're called lenders, borrowers, and investors. I think from those words like lenders, borrowers, and investors, it's quite clear, at least a little bit, what they mean. But let's still consider some specific examples to make sure we're on the same page. Let's play the game. It's called lender, borrower, and or investor. By the way, I decided to use this sign, it's a participation sign. So please, when you see it, this is probably some question to you. So let's imagine the situation. For example, you take a loan in a bank. In this situation, who is a lender, who is borrower, and who is an investor? Please tell it with your microphone, or just type it in the chat. What do you think?
I'm borrower.
Yes, if you take a loan, you're probably a borrower. And what is the role of the bank?
Lender.
Yeah. Okay, this was a simple one. We also have something in the chat. Yes, exactly, Daniel. That's right. So, okay. For example, if you vice versa, you deposit your money into a bank, then
we become lender.
yeah, it becomes vice versa. Then we are a lender, and the bank is effectively borrows money from us. So what if you decide to buy a portfolio of stocks?
Investor, maybe.
Yeah, then we are investor, and this is a tricky question. What if you buy an apartment in Moscow, for example?
It depends what our plans for this apartment. If we're going to rent it, then we invest money.
No, just if you buy it.
I believe it can be called an investment into like
Maybe borrower.
It depends. It depends actually. Yes, how you look at it. For example, many people, you know, they buy apartment by borrowing money, like taking a mortgage. It's called. And in this case, you can be considered as a borrower, but when you take money from bank, and as probably who was saying first, I don't remember. Sorry, you were also right that in generally buying an apartment is considered as an investment. It may be a little bit counterintuitive because, for example, when you buy something in the supermarket, for example, a loaf of bread, you're neither lender, no borrower, no investor, right? Because you just like buy something and use it. But for apartment, it's considered like you're saving your future rental payments. So you pay money now for the apartment to avoid those payments in the future. So it could be considered as an investment. Okay, this was the last one. And now let's discuss financial market participants, because as we said, the financial system is a system of interactions of those participants. Could you please name what financial institutions do you know? There are a lot of them, so just you can type in the chart whatever you know.
IMF.
Oh, it's a good one. Yes, for example, IMF, you mean International Monetary Fund, right?
Yep.
Yes, this is an international organization. Central Bank, I see, yes. Reserve Bank of India, which is effectively, yes, also central. Any other assumptions? Yeah, investment companies, right? Okay, let's just, I'll skip to the, yeah, commercial bank, government brokers. Yeah, that's right. Actually, this is a slides where I just wrote down all institutions I could think of. But of course, this is not like every financial institution that exists. This is just some major types I thought of. So you see that there could be a lot of them. And also everything that you mentioned is also correct. So we're now going to discuss some of them, which is the most important from my point of view. We will start, of course, with commercial banks. Commercial bank, you probably all already faced a commercial bank in your lives. And commercial bank has three major function. It provides us with access to deposits, with taking loans, and also providing us access to the current accounts. Here you can see some labels of some bank examples, like for example in Russia it's Sberbank, it's a major Russian bank. I think most of you know it. Citibank, for example, also can act as commercial bank, and we all have the Citibank scholarship card. Okay, and here you can see a picture. It's a bank which named in Italian, but I believe it must be pronounced as something like Monte dei Paschi di Siena. This is the oldest bank in the world for now. It was founded in the 15th century, and it's in Italy. And here, as it looks like, its entrance looks like. Okay, so let's consider such a simplified and exaggerated example of banks. Commercial banks actually they play a crucial role for the economic development, and let's demonstrate it on this quite very simplified example. Assume we have a bank and it has nothing. It's just empty bank. And then suddenly we have some individual who got some money, for example, inherited it or just earned or whatever. He has excess of money and he wants to deposit this money in a bank. So now bank will have some cash, and it can provide a loan to another individual. So this individual, for example, is going to buy a house. So, and he does. Now assume we also have some guy who is building houses, and as he sold house to this first individual, you can see my pointer, right?
Yeah.
Thank you. So this individual who is selling houses, he also now has money, so he'll also deposit it in the bank, and bank uses this new cash to provide another loan, and this another loan taker can buy a car, for example. And again, a guy who's buying a car has money now, he can deposit and another loan. And for example, this guy want to found a company. He has some idea and he just needs money to use it, and found some successful company. And here we can see that we just started with one amount of money, and eventually we have this the effective size of this money volume was actually tripled, because you see how much money we have as our buying capacity in the economy. Yes, it's tripled. So the bank, it allows to increase economic activity substantially. Is it clear from this scheme, or do you have any questions? Okay.
Clear.
Okay, thank you. Okay, we have something in the chat. Okay, clear, thank you. So let's now assume that there would be no bank. And this example is even more exaggerated, but still, for example, we would have this guy who inherited his money, and he would probably be doing okay without a bank. He would just keep his money, I don't know, under the sofa or somewhere, but for now he would be okay. But for example, this guy who wanted to buy a house, taking a loan, he wouldn't be able to do so, and he would end up, living somewhere else. And in terms, the guy who's selling houses, he wouldn't be able to sell them, so he would eventually probably go bankrupt. And the same for a guy who wanted to buy a car, and he's now very uncomfortable without it. And the same for a guy who wanted to sell this car, and he couldn't because there are no buyers. So what point does it make? He would also go bankrupt. And this guy who wanted to found a successful company, but he couldn't because he just didn't have money. So, and we see that amount of money in the economy would be much less, the economic activity would be much less, and it would be quite inefficient distribution of money, actually. So this is the main role of commercial banks in the economy. Okay. Now, could you please tell me what is the amount of free cash available in this bank in such situation?
Maybe none.
Yeah, because in this simplified situation, every cash the bank got, it used to provide loans. So the bank now has no free cash. And let's now imagine what would happen if everyone wanted to take his or her money back from the deposits. And actually, they can do this. This could happen. Then the bank would not be able to pay back its depositors. And this situation, when everyone wants to withdraw his or her money simultaneously, is called a bank run. And this is a symptom of this economic crisis. It happens often when everything is bad. But it could be such so that, for example, that initially it was nothing bad, but then people suddenly started to came, the probability of bank problems increased, and other people understand that, and they also want to come, and it's like it's getting worse and worse, and probability of the bank default is only growing. So that's why bank should always maintain enough cash in its balance, just to make sure that this situation would never happen, or happen with a very, very low probability. And here are two examples of the bank runs. The first one you see from the left, it happened in US during the Great Depression. You probably heard of it. And in Great Depression, it was really bad, severe economic crisis in the United States. So the reason why all those people are standing here, they are real. And for example, on the right, you can see this example from the last year, not last year, now it's 2019. There was a Metrobank case when some just fake rumor was spread via WhatsApp, and it just people started panicking, and they believed that their money not safe, and they started to withdraw their money from the account. Somehow Metrobank managed to survive, but just because of panic, it lost, as it stated in the internet, 24% of its customers. So what is the purpose of the slide is to say that the bank run could happen as well because of panic as because of some real reasons. Okay, that's it for banks. Let's consider another important financial institution. It's called exchange. Exchange is a marketplace where you have traded different securities, financial instruments, commodities, and so on. And there are different. Please, by the way, please type plus in the chart, or just something that you heard of exchanges, that they exist. And as well, please type if you don't know, minus, for example. Okay, I can see plus, minus. Okay, I can see minus. Another okay. I see. Good. Okay, exchange is just some place where many things are traded, and there are different types of exchange. The first major type is a stock exchange, where for all, not all, but stocks are traded. For example, you probably heard that about Apple stocks, like Tesla stocks. I don't know, or it's called stocks or shares. For example, that Apple costs, for example, over $1 trillion or something like this. This happens on exchange when people trade with each other with those stocks. Also, on stock exchange, there could be some other instruments traded. And another type is commodity exchange. Commodity exchange is exchange where in the same way traded, but not stocks, but commodities like oil, metals, coffee, pork, and like rice, tea, etc. Of course, not like everyone comes, with a barrel of oil and is trying to sell it to other people. No, it's all in distant format, but still usually it's all around the commodities. So you could see some labels. Maybe you recognize that you've seen them before. Like the Moscow Exchange is their probably biggest stock exchange in Russia. And also we have commodity exchange in St. Petersburg, which is not here. NASDAQ and NYSE, I don't know, those are exchanges from United States. These are also United States, London, and another United States label. Okay, but many things traded on exchange, but not everything. And when something happened outside the exchanges, for example, we will talk later about the instruments which are not available, which are not generally available on exchanges. This is called that this is traded on the over-the-counter market, or simply OTC market. Let's consider one example. The purpose of this example is to show that the exchange is not only about just the place where you can come and choose from many variants what you want to buy, but it's also about safety. For example, let's consider an example when we have some farmer and he agrees to send the milk to his counterparty. And he sends the milk and expect to get the money back. But it could be so that this counterparty, you know, his face is not so good, and he was a fraud, and he could just not send the money back. And this is not this is an unpleasant situation, and probably if you were this farmer, you wouldn't want to be in such situation. This problem could be solved with the help of the exchange, because the exchange is a place which essentially guarantees that guarantees the provision of both money and some asset, and only after that the transaction happens and everyone is safe. So apart from that, just the fact that exchange is a comfortable place to find what you want, I mean, in terms of financial assets, also it's about safety, that it's usually guaranteed that you will get what you want to buy, and your counterparty is not a fraud, and it will not default, you know, after you paid him or her. And here you can see how exchange looked in the past. You probably saw, maybe you could see some movies on the financial trading, and in the past it was like this. So trades were made manually, and now everything, or almost everything, became electronic. And here are just some example from the media. And another definition is that when some company is trading its shares on the exchange, it's not so easy. For example, not everyone can, if I open some shop, you know, near my apartment, I will not be able to trade it on exchange. So to trade your company on exchange, it's a complicated procedure. We will maybe talk about it later, but still not everybody can do this. To get to the exchange, you must to go through complicated procedure and checks. And if the company is traded on the exchange, it's called listed on exchange. And it's usually quite important for companies to be listed on exchange when they become big. And for example, according to this title, we see that this NYSE, New York Stock Exchange, probably will delist 3 big China telecoms, which means that those Chinese companies will not be traded on New York Exchange. And this is a big deal. I mean, relatively, but still a big deal. First of all, because it's very bad for those 3 companies, because this NYSE exchange is one of the biggest and well-known exchanges in the world, and it's just very bad for their companies, I guess. And another thing is, you probably heard something about the worsening of China-US relationship in recent years, and of course, it's just another sign that something is going on here. So that's how this title could be explained. Oh, another example. Here I'll probably need to write something. Let's assume that you want to buy something. For example, so you chose some model of a car. What would you do to buy it? How would it look? Please tell me. Or maybe type something in the chat. Okay, my proposition would be that you would go to their market and you would first of all look what do you have offered. For example, one seller would offer you the same car for, oh, I'm not good with this tool yet, sorry. Okay. You would probably come to the best price. For example, someone would offer you, for example, 4 million rubles if you're in Russia for this car. Not offer, but ask you. Another one would ask you 3 million, for example. The last one would ask for 2 million. Of course, if we're talking about the same car model, you would not go to this two. You would choose the best price, right? And you would come to this buyer and, for example, you would say, okay, sorry, I only have 1 million. I don't want to pay more. And he would say, I still want to sell the car, but you know, okay, I'll make you a discount, maybe to 1,600,000. And you would consider this and say, okay, I maybe take an additional loan of 4,000 and I would offer you this price. And then he would say, okay, and then you would find some balance and you would choose a price. And that's probably how a typical negotiation and trading process would look like. And that's actually some balance between the supply and demand, right? And that's how it looks like on exchange. The principle is quite the same. There is such a approach to record all their interest, all the desires to buy something, all the desires to sell something. It's called order book. You can see it here on the left. On exchange, many traders, dealers, they come and they make an orders about the interest in some asset. For example, this guy, he's stating that on this price, he is willing to sell the asset. And this guy, for example, says that on this price, he wants to buy an asset, and so on. And when the trade happens when we have an agreement between the seller and the buyer about the price, exactly as in the previous example with the car. So as soon as those possible selling price are called asks, and the possible buy prices called bids. And we only have trade if some bid equals some ask. Otherwise, we do not have balance and it's not happening. Is it clear? Any questions, please?
I have a question, please. I don't know what is market size. I mean, what does these numbers mean?
Market size, it's not actually much important right now, but the market size, it's not the whole order book you can see now. So some part of this is just cut off, and the market size is actually then if we calculate all orders and we calculate its share we would get, for example, this share of all orders. So we have many orders in this order book, and for example, for 30% of the sell orders, of 31 almost percent of all sell orders, there would be such price.
Okay, thank you.
Yes. Okay. And now let's consider an example how this price could change. Assume something happened. I don't know. There is a rumor that some asset, some company is going to grow soon. Its price is going to grow, and everyone wants to buy this asset or this company. And let's think about what's going to happen. Of course, if everyone wants to buy,
Prices will go up.
yeah, right. But what about the mechanisms that, that some trader will come and make a higher bid, and another higher bid. And as soon we have a bid which is high enough to take this price away, it will happen. The trade will happen. Then another one will come. You know, if he wants to buy so much, they will have to increase the price to make it as soon as possible, and those low asks will disappear soon, and there would be some new bids. So we would have some new trade price. It would be somewhere around here, for example, right? So if everyone comes and starting to buy, we will have an excess demand and limited supply. And in this case, we would have to, the market would move the price up. So it would find a new balance. It's clear, right?
Yes.
So that's how the market price could go up. Okay, next example of financial market participants would be non-financial companies. For financial companies, it's quite clear how they can participate because that's the nature of the business. But for non-financial companies, it could be not so clear. Let's consider an example. For example, we have some big IT company which wants to launch a new product and it needs financing. What options does it have to get the money? The first one, it could just go to a bank and ask for a loan. Just, okay, could be an option. And there are also two major options for big companies. The first one is to issue shares. So when we talk that some shares are traded on an exchange, it means that the companies, first of all, issued those shares. So not every company has its shares, but for big, huge companies, it's usually the case. When you sell the shares to investors, you actually, not you, the company shares the ownership of itself. So when you buy shares, investor buys shares, it buys actually some share of this company, as stated from its name. And effectively, he or she becomes the owner of some small part or maybe big part of the company. And another analog of the share name could be stocks. Some it's absolute synonyms. Maybe officially they're not complete synonyms, but in the media, in talking, it's completely the same thing. Sometimes it can also be called equity. And here you can see picture, for example, dynamics of the Apple share price, just for example. Also, I would like to notice here that why would investor buy shares? Probably because The one reason, because he or she could expect that the company price was go up and he would just sell it and earn some money on it. But another reason could be that shares, they pay dividends just because, you know, you believed in the company and you give money and they want to, you know, to make it more interesting to you to do so. And they can just pay you money from time to time to make it more attractive to the investors. And this thing is called dividends. This is just example. This is example from December 29th, but from this time, I believe Tesla grew much more. And this is just some examples that share price of Tesla is going up, and you know, produces an army of Teslaneers, which is just some pretty word to describe people who earned a lot of money and become millionaires on buying Tesla shares. And another thing, as I said, it's not just so easy to issue stocks or shares. You should undergo some complex checks and procedures first. And when the company decides to issue shares, it's called initial public offering, or IPO. You probably heard this more like IPO if you heard at all. And here you can see, for example, that recently in December, Ozon IPO happened. Ozon is a internet commerce Russian retailer, probably the biggest one, and it went pretty well. And as it's stated in this title, it was the best IPO debut of Russia in the past 9 years. And also we can see that Yahoo Finance title states that the last year was one of the best years in the previous 20 years, the best year of IPOs. Why? I don't know. Maybe everyone just needed money so much, or maybe just it happened by coincidence. Okay, another option to raise some capital, it could be issuing debt. What does it mean to issue debt? Another synonym of it could be issue corporate bonds. Which one of these is more common, I can't say. These are actually synonyms. And when the investor buys a corporate bond, effectively, it just pay now to get some fixed interest payments later, also called coupons. This is the payment scheme, and it looks something like this. When investor buys a corporate bond, he or she pays money now, and later receives some payments from time to time. For example, if the coupon say 5%, in this case it's 6%, so it pays every 6 months, it pays 3 million for the 100 initial amount of the investment. And eventually you or investor, you get the initial investment amount back with the last interest payment. That's how the classical bond payment scheme looks like. Okay, and here is another title from Financial Times stating that corporate debt sales will go down in 2021 after record boom. And record boom of the companies issuing debt could be probably explained by this coronavirus pandemic, because it also caused some economic problems and everyone needed money. And this is just my assumption. I didn't check it, but it would be reasonable to assume, I think. that when companies have some problems and they need money, it would be okay to expect that would issue that. What do you think would you buy as an investor, debt or shares? Let's discuss just some major pros and cons. We already have. It's a new one. This is probably some old comment about the car. For some reason, I only saw it right now. Sorry. Okay. For shares, as we saw, for example, for Apple shares, it went up very fast. The main plus is that if you're lucky, if everything works out well, you can get a very high upside. So, for example, you can invest, I don't know, 1,000 and you will get 10,000. So your investment may increase several times in a short time if you're lucky. But and the problem is here that you as well maybe get not so lucky and you may lose also money. So the risk is also higher. For example, you invest in company and it faces some major financial problems and the share price goes to almost to zero, and it's also a high risk. And it's clear from here, it could be clear what are the pros and cons of the corporate bonds. Payoff is predictable. This is a good thing. So you invest money, you know that you'll earn something on it. Like, you know this for sure. If company does not default, but let's assume we believe in this company that at least it will not default. Default means goes bankrupt or will have to face some problems with paying off. We know that payoff is predictable. This is a good thing. So we don't have to worry. But on the other hand, we will never earn more than is predictable. So we will never increase our initial investment several times with corporate debt. It will never happen. So here, investor would choose some balance between the will of getting a high upside and a will to avoid risk. What's next? Brokers. Brokers is an important participants of financial market as well. For example, what's broker? Let's consider this definition. It's just some intermediary who is between the buyer and the seller, and the broker is the institution or just a person sometimes, which provides an access to the market. For example, let's consider an example. I'm sitting right here, right in Moscow. I'm just a student at Skoltech now, and let's assume that we want to buy a share of Amazon. What would I do? What would you do? So I cannot go to the exchange because it's Amazon is not traded even in Russia. You know, I would have to probably go somewhere in London or in the United States. But I don't want to do this, but I want to buy Amazon shares, for example. What would I do? I could go to broker, and brokers are everywhere. They're all around us. In Moscow, there are a lot of brokers, and I could go to the broker or just press some buttons in my online bank to open a brokerage account and to ask my broker to do so. For example, here you can see a screenshot from the brokerage account of Sberbank. Sberbank is a major Russian bank. If you live in Russia, you know this for sure. If you don't, so you will soon. You can just go to the Sberbank brokerage account, just press this button, and you'll buy it. So the prices are in rubles just because you can choose the setting if you show it in ruble or in US dollars, but still you can buy indeed Amazon shares. So that's why you need a broker to make it much easier to you to get all those financial assets, financial instruments, and so on. You couldn't do it just, you couldn't just buy it Amazon shares without broker. Any questions? Okay. Investment bank. This is a short slide. I just want to tell you that they exist. Investment bank. There are also investment companies and so on. And their main, the best known functions, they're listed here. It could be raising capital by issuance of securities. For example, when a company wants to issue shares or corporate bonds, it may probably go to the investment bankers and they'll help to do so. They also organize mergers and acquisitions, or in short, it's called M&A. That's, for example, when one company merged to another company, or one company buys another company, investment banks will help with that too. Asset management is when you may give your money to some institution to manage it for you. They also provide a brokerage service. Brokerage could be a separate service, or it could be just a part of investment bank, or just commercial bank, or some other bank. And also investment banks are involved in trading very much, and in market making. Market making is essentially the same as trading, but market making assumes that there's always someone who is here for clients if they want to buy or to sell something. That's similar to brokerage, but not exactly the same thing. And here you can also see some labels of the major investment banks. Maybe you saw or recognize some of them.
Sorry, may I ask?
Yeah, sure.
I don't quite understand how the broker works. For example, if we have a person that they wants to sell 15 shares of Amazon at fixed price, and how the broker works. So he tries to find a person who wants to buy 15 shares at this price, or
let me show you. Maybe I could draw a scheme. Let's assume here is we. Here is the exchange. Let's assume that all stocks are traded in exchange. You cannot come to the exchange directly, no way, because to do so you would need very strict requirements. You would have to have a special license. You would have to provide a lot of capital that you probably don't have. Capital means a lot of money. You would need to have some very complex infrastructure. You should have probably some location which is close to the exchange and so on. But so you cannot do it by yourself. But there are some brokers who do this on the regular basis. So they have all this license, they have capital requirements, they have infrastructure and so on. So here is brokers. Broker is usually an institution. Probably a person also could be, but he would still have to act as an institution. So you come, for example, say, I want to sell Amazon, which you already have, or as a matter of fact, you may not even have the share. We will talk about it when we talk about investment. investments, and you say, I want to sell, for example, for 240 rubles, one share. This is a little bit higher than this price stated here. And the broker will just go for you and make an order to the exchange for the same price. So here will be an order book of the exchange. Here would be asks. Here would be bids. And for example, your price would go somewhere here. And this is not a broker who decides if the trade will happen. This is a market who decides. If there would be enough demand for your share for this price, broker would sell it on exchange. If there would be no demand for this price, your order will just be waiting here, and that's it.
Broker need to find one person that wants to buy 15 shares.
A broker is not
Oh.
actually finding a person. Broker just transmits your order to the market, because you cannot have an access to the market yourself, and the broker can do this for you. And he just comes to the market and announce your price. Like imagine you come to the market like on the street, and you say, okay, I'll sell my, I don't know, apples for $10 for kilo, for example. If anyone interested, the trade will happen. If there is no one in the market who is interested, so the market is just the common place. Everyone sees what's going on. So you don't have to look for a specific person. You just announce your price. If everyone is interested in this price, the trade will happen. If no one is ready to buy at this price, then the trade will not happen. So the broker is just the one who states this price for you.
Okay.
This would not, by the way, exactly be, it's not always the exchange. There is also OTC market, as we discussed. This is not for Amazon shares, could be, but some, maybe for some corporate bonds, it could be OTC markets, just.
So should it be some contract between peoples, between a seller and a buyer, or something like that?
Yeah, of course. All this contract part, you actually make an agreement with the broker here initially, and then all the documentation that happens here, it exists, but they usually do not overwhelm you. But this, of course, everything is documented. There is a special, another third party, it's called depository, where every security is stated. For example, here is, if the trade happened, assume someone, you don't know even who it was. You just know that someone bought it here. Let's call this the person X. And he owes this Amazon now. Oh, sorry, this was you before. And you had this Amazon share. And is a depository. Everything is accounted here. So they'll write here that, sorry, that you don't owe this Amazon share, and they'll write it down to this person X who bought it, that they owe it now. So everything is, of course, is documented. And the broker, I don't know for other markets, but at least in Russia, as you know, brokers, they are supposed to send you back the brokerage report every day. So what happened at your account, even if you did nothing, they will send it anyway.
Okay, I got it. Thank you. Okay.
We will talk about what happens on this trade later in the investment part of the course. Any other questions? Can I continue? Okay, let's continue with. Okay. we have-
Alexey Larionov asked in the chat, can
Uh-huh.
the same company be traded on multiple exchanges?
Yeah, sure. Yeah, it happens all the time. You have to just agree with each exchange separately. But yes, it's a common case. Many companies traded on many exchanges.
Sonia, I also have a question. How brokers get their profit in the market?
Uh,
So they buy your shares and sell them for someone, but what's the profit for themselves?
yeah, they just take commission on every transaction you make.
Okay.
So I buy this Amazon, and they'll probably take from this transaction, I don't know, 0.6%, 0.6% or something like this, and this they earn on commissions. Yeah, there could be some other conditions like commission not on transaction by some other stuff, but this details. Any other questions on brokers? Brokerage? Okay. Let's continue with mutual funds. Mutual fund is in Russian, it's called Паевой инвестиционный фонд, or PIF. I'm just saying this because it's a very specific name. Mutual fund is this type of fund which actually has only one portfolio. So they have one strategy. They don't care what their investors like want more or less. They just have one portfolio. And they collect money from all investors and just share this portfolio between them. So they have the pool of money from different investors, and all these pools they invest according to the same strategy. Okay. And another example of fund could be an exchange traded fund, or ETF. ETF is absolutely the same as a mutual fund, but the only difference is that ETF is traded on exchange and mutual fund is not traded on exchange. So if you want to buy a mutual fund share, you would have to go to the OTC market, or the counter market, which is the market which is not an exchange. And if you want to buy ETF fund, you can just do it on exchange. Let's consider an example. For example, you were sitting and thinking and decided that it would be a very cool idea to invest, for example, in 500 biggest US companies at the same time. It would be very hard to do it by hands. You would have to press a button 500 times, and there is quite a chance that you won't be able to manage it, because the prices are changing constantly and you would have to follow it. It would be like really complicated, and probably it's absolutely not convenient to do it by yourself. But what could you do instead? You could go to your broker, because you cannot buy everything on the market by yourself, and you could ask, is there any fund which already does it for you? And you could then just buy a share of this fund or buy ETF which already has exactly this investment strategy, and just buy it, and that's it. You just press one button instead of pressing 500 buttons. For example, here the Vanguard is S&P 500 ETF. S&P 500 is a name of this strategy of investing in the 500 biggest US companies. It's quite a popular portfolio of S&P 500. And Vanguard is probably the biggest fund in the world. And by the way, when I was preparing this screenshot, I discovered that Vanguard is actually an owner of several percent of Sberbank. which is for me was a little bit counterintuitive because it's common. It's commonly considered that Sberbank is a state bank, and here is an American fund, which owns like 1 or 2% of Sberbank. Okay, that's it for funds, and here we come for central banks or regulators. There are actually many types of regulators, but we will talk about central banks because they are the most important and the most probably significant for the market and for the economy. Okay, what central bank do? They have several major functions, and I want to say that this could be different for different countries, but the main picture is probably the same. And also central bank can be called differently. It could be central bank, it could be Bank of England, for example, Bank of Russia. It could be called Reserve Bank. For example, someone typed it in the chart, the Reserve Bank of India. It's also a name of central bank. In the United States, it's called Federal Reserve System or just Fed. It could be called National Bank of something and so on. But the function of all those names is just one, it's central bank. And central bank main function is it manages monetary policy. Okay, let's just do it one step at a time. Let's start with monetary policy. What's monetary policy? We have two major types of government financial policies. It's monetary policy and fiscal policy. Let's start with monetary policy. Okay, monetary policy is the responsibility of central bank. As we said, the monetary policy is about key interest rate. The central bank has a way to affect the interest rate level of the market. We will talk about it more a little bit later. Also, is central bank is doing so-called printing money. Officially, it's called emission and controlling the money supply. And the main goal of this monetary policy is inflation in Russia and in most countries. It's inflation. If you don't know what's inflation, we will talk about it also in a couple of slides, in several slides. So that's what central bank do. They think about inflation and they can affect it via setting the interest rate level in the economy and printing money. Printing money is an official name, but I think it translates its meaning quite well. And the fiscal policy, we will not discuss fiscal policy further, but just to know that there exists monetary policy and fiscal policy. Fiscal policy is the responsibility of Ministry of Finance. I guess every country has its Ministry of Finance, and they manage fiscal policy. There is no official aim of fiscal policy, like, for example, in monetary policy, it's inflation. It's like stated, and it's no second options. But fiscal policy, it's in general, it's supposed to contribute to the economic stability and growth. Just do what best for the economy, you know. And it can be implemented via the setting the tax policy, for example, what is the income tax, what is just some goods tax, and so on, and also managing government expenditures. So in other way, it's about how to construct a governmental budget. So every country has its budget. It pays salaries for teachers, and so on. It's spend money for medicine and so on. So fiscal policy is about how you fill this budget and how you spend it. Any questions here? Another very important function of the central bank, it's financial institution supervision. It's not highlighted here because this name of this point is quite explaining itself. So central bank is the institution which controls all the financial institutions we just discussed previously. Banks, exchanges, everything. Just controls how they work. It has some, they set some rules for those institutions and so on. And let's move to reserve management. Every country has probably not every country, but most countries, and definitely all developed countries, they have their own foreign exchange reserve, which is just a huge portfolio of foreign currency, just in case. Here is why it can be held. The first, in Russian, it's called, again, it's very specific name, where that's why I said золотовалютные резервы. The first aim of those reserves is to provide a level of confidence that you can meet your external obligations. For example, if you import some goods, those reserves, they are like a guarantee that even if your economy for some time is not doing well, you can still have some reserves to pay for the goods from abroad, for the import. So this is like a guarantee that you always have money. If you need to pay, you will just use it. It can also be used to support the domestic currency. Some countries, they try to affect their national currency exchange rate to foreign currencies. We will also talk about it today. And they can use their foreign exchange reserves to do so. And also for some countries, another aim of having a foreign exchange reserve is just have money to, in case of some disasters, catastrophes and emergencies, like earthquakes, maybe something like this. And here is just some table from Wikipedia on the size of the volumes of foreign exchange reserves of different countries. You can see that China has biggest reserves, and Russia actually has one of the biggest foreign exchange reserves in the world. And you can see this is in $1 million of US dollars. So this is essentially half of the $1 trillion of foreign exchange reserves. The question is, where are the United States? How do you think? Why there is no United States? I mean, we all know that United States, this is the biggest, the most successful country economically in the world. Why they're not in top of this? There is something in the chart.
It looks like they're super confident in their future.
Yeah, that's a good assumption, probably. Actually, the cost of foreign exchange is the US dollar. They can issue new dollars. Yeah, that's close. Yes, they can issue new dollars, but you know, we also can issue new rubles. But yes, the idea is exactly okay. Is exactly good idea because as we stated, one of the main aim to holding a foreign exchange reserves is to guarantee to everyone that you can meet your external obligations. Yes, one assumption could be they are so confident in their economy that they do not need reserves. But for example, so is Japan, so is Switzerland. They're also quite successful country, but still they have reserves. The main reason actually is that most international trades transactions, they are made in US dollars. So as you said in the chart, yeah, they can just print dollars if they need. So they don't have to worry about they cannot pay for some international transaction because most of them are already in their national currency. For Russia, of course, it's not the same. You can usually not trade with other countries in Russian rubles. No one wants, to make trades in Russian rubles. And the last point, what central banks do, they manage the the national payment system. Why it's so important, we will consider in this simple example. Let's assume that we are in Russia and we want to transfer $100 from you want to transfer these dollars from your account, from some Russian bank, to your friend's account in some Russian bank. Yeah, let's assume that you both have US dollar accounts and you want to transfer money. How do you think it happens? And this is a participation sign, you see. Maybe this is a tricky question. This is not easy, but maybe you have some assumptions. How could this be arranged? Any assumptions? Here is something in the chat. By the SBP. The BP is a system of fast payments. Yeah, but this is also a payment system. I mean, okay, let's consider an example. Something other in the chat. Exchange USD RUB, transfer RUB USD. This is a good assumption, but it's not the case.
I guess it may be somehow connected with the topic we just discussed.
With the foreign exchange reserves?
Yeah, maybe it is somehow connected with it. I don't know how, but probably, I don't know.
No, it's not. It's not connected. Let's consider an example. That's how we see it, right? Another something in the chat. Can you clarify the question more? Ramilia, yeah, you're close, I guess, if I understand what you mean. Clarify the question more. Okay, we want to make a transaction in US dollars when we are in Russia, and both me and my friend, we are both using Russian banks. Then the question is how this transaction is happened behind the scenes. You know what? Because what we see that this is my bank, this is my friend's bank. I just see that from my account it's minus $100, and in my friend's account it's $100 more, right? So that's how we see it, and we don't have to see how it's actually happened, right? And this all happens in Russia because we are in Russia and we have Russian banks. That's how simple it looks like. What actually happens? The problem is that Russian banks, they cannot do transactions in US dollars, actually. So if you are a bank and you want to do a transaction in the foreign currency, you must have some counterparty in this. Yes, Daniel, you are exactly right. I don't know how you know this, but this is impressive. Yes, then as Daniel said in the chart, if you want to make a transaction in foreign currency, you must have a corresponding bank in this country, which currency you use. So our bank one must have some correspondent bank in the United States, which would be keeping its US dollars. And the same, our friend's account must have its so-called correspondent bank also in the United States. And our Russian bank will send a message in this course in its correspondent bank, and its correspondent bank also will send a message to the Federal Reserve. Federal Reserve is the central bank of the United States, and Federal Reserve has accounts of both correspondent bank 1 and correspondent bank 2 accounts. And Federal Reserve inside it can make a transaction between those two accounts. And after this transaction happens in the Federal Reserve, the correspondent bank 2 gets the message that it happened. It states, okay, I have $100 more. And then this bank correspondent sends a message to the Russian bank 2, and only then we know that our friend account is now $100 more. So those banks may be in Russia, but the actual transaction, it happens in the United States. Moreover, the dollars which we do not have in cash or in hands, they never leave the United States. They are always in the banks in the United States. So even if we see that we have something in our account, that actually they're held in another country. So that's why each country must support their own payment system. So United States have their own payment system, Russia have in turn their own payment system, and so on. That's basically it for the financial institution part. Let's probably have a break for 15 minutes now. Or if you have any questions, you can ask. Or let's make a break for now until 11:45. Okay, see you in 11:45. Daniil and Vitaly, if you're here, I can answer you now. Okay, let's maybe do it after the break. I'll answer you after the break. I think we can continue. Sorry, do you think the recording is on, right?
Yes.
Thank you, because I don't think I don't see it. Let's start with the questions. Oh, by the way, I remembered that I need to check the attendance. So could you please type something in the chat that you are here, and if you are not using your real name, maybe please type your name as well. And by the way, if you're in a waiting list, you probably need to do it as well. Let's start with the questions of Vitaly and Daniil. Vitaly and Daniil, are you here? Are you back here? Vitaly, I see yes. Daniil, yes. Okay, let's start with the question of Daniil. What happens if we take the money in cash? And if we take the money, do we get it from the US bank in case we cash out in Russia? The answer is yes. Actually, every dollar you ever get from anywhere, you get it from the US because it was printed there. And if you just withdraw it from your account, of course, it's the money which officially belong to your bank, your Russian bank. But the dollar you get in hand, they someday were in the United States. And I also have I heard a funny story from my former colleagues. I used to work in finance, and I started in Sberbank, and a colleague of mine told such a story that maybe, I guess most of you, at least who lives in Russia, you probably remember that in 2014, there was a ruble economic crisis when the ruble dropped like in a couple of months. It lost half of its value. So it started like from 30 rubles for US dollar, and in a couple of months it was like 60 or 70 rubles for the US dollar. And we just discussed in the beginning of this class, we discussed bank runs. And of course, all Russian banks, they expected the bank runs, but not just the bank runs, but the bank runs for US dollar and euro. And the problem was that you cannot generate US dollars in Russia. So if you expect that many people will come to your bank, you must provide enough cash, even it's rubles or it's US dollars or it's euro. You have to provide enough cash to guarantee that you will fulfill your obligations to clients. Because if you cannot do so, it will be like a very bad thing. It will be technically it will be a default of the bank, and it would be a very bad sign for the economics. And so all banks, they started worried about where to take US dollars. And when you expect a lot of people coming for the foreign currency, you need a lot of US dollars, right? And the question those guys solved, it was, what is the biggest amount of the US dollars you can put in one plane to get from US to Russia? How do you think what this number was? Any guesses? You can type in the chart or just say, what is the biggest amount of US dollars which you could place in a plane, in the airplane, to bring them from US to Russia? I mean, not when you're acting like individual, but when you're acting like a company. When you, like for example, US Bank, and you want to bring money from US, like it's a separate plane. It's a whole plane for money. You know, how much money can you? Yeah. Yeah, the actual answer, I don't remember it's exactly, but it was around maybe $500 million of US dollars. But of course, eventually it was not about the volume. So it's not how much you can physically, you know, place in the airplane. It was about, you know, all flights, they all must be insured. And just no company wanted to insure such a flight where would be much more US dollars, because, you know, if something happens to the plane, this company would just couldn't survive. I mean, insurance company could not be able to cover the loss if something happens to the plane. So that was the story. That's for question of the EU, that yes, all US dollars you have in hands in Russia, they come from the United States. And another question of Vitaly is what if the corresponding bank of this is the same for different Russian banks? That's a good question. That may actually happen. And in this case, this is just one of possible cases. Another case could be, for example, that those two banks have the same bank correspondent. Then this bank corresponding bank would just make a transaction within itself. It wouldn't need another correspondent bank, or it wouldn't need help of Federal Reserve. So that's how it works in this case. And it could be even another case, that those correspondent banks are different and they still do not use help of Federal Reserve. This could happen if, for example, those correspondent banks are very huge and they already have this transaction line with each other, so they cannot, they do not need Federal Reserve to make this transaction for them. But this is a general case. So if they do not have this account in these different banks, this would go through the Federal Reserve Bank. Okay, any other questions before we continue to this part? Okay. By the way, I want to warn you that I'm not really good at time management. So if it somehow happens that it's already, say, 1 p.m. and I don't see it, you please just tell me, because it may be the case that I'll just don't notice. Okay, let's start with such a pretty commonly used definition of developed and emerging markets. Probably intuitively, it's clear what it could be stated for the developed markets is markets with high income. They're open to foreign investors. Everything is transparent. The law system is transparent. Financial institutions are efficient, and the markets, you know, they're acting actively and so on. Here you can see the map. You can see a map where developed markets are marked with a pink color. Those, of course, United States, Europe, at least half of the Europe, Australia, Japan, Canada. Yeah, Japan said. And emerging markets, they are something close to the developed markets. They are just developing. The emerging is a synonym of developing. They have some characteristic already of the developed markets, but still they're not there. They're coming, you know, to be developed markets. That something is not meeting the developed markets standards. And you see here emerging markets in blue. So it's Russia, India, Kazakhstan, China, Nigeria. I believe we have someone, Kenneth. I remember you, we were at the same team. uh, uh, so Nigeria, Brasilia, you see a lot of countries. Okay, let's continue just to remember that there are developed markets and emerging markets, and those definitions are.
Yes, so there's a question of the gray color, the countries in gray, what the market types.
Not just qualified as either developed or emergent. So
Okay.
I'm not sure about the specific term about those countries. They're probably something like underdeveloped or something like this, which are on their track to be emerging. Probably, actually, I saw several variants of this map, and sometimes those countries can vary. So sometimes, you know, something is not exactly as it is. So it may be the case that some countries are missing. I just, you know, looked at, okay, Russia's here, China, you know, Brasilia, United States are correct colors. But it may be the case that some country which is doing quite well is not marked with a color. Did I answer your question?
Yes, thank you.
Okay, these are commonly used definitions. Just remember them. Okay, gross domestic product or GDP. I'm quite sure that most of you heard of this term. GDP is a monetary measure of everything that was produced in a country over some period of time. Or actually, the point of this measure is to estimate the economic activity in the country, and it could be approached in different ways. It could be, for example, calculated through their production. It could be calculated through the country's expenditures, through the country's income. There could be some different calculation techniques because, of course, in a country level, it could be complicated to calculate everything precisely. So there are different approaches. But those are some synonyms of the GDP. It could be also called size of the economy, total country's expenditures, country's income, and so on. And here you can see some ranking of the biggest economies in the world as for 2019, according to the World Bank data. And it's probably well-known example of the United States, which have a higher GDP in the world. Here's China, third is Japan. And you see that Russia is also quite high in this ranking. Here are some examples of titles of mass media titles. And all those titles are essentially about the GDP. It could be, for example, COVID pandemic could bring a lost decade of economic growth. Economic growth is about how GDP changed, how it's growing. So if GDP of the country is growing, it's a good thing, and it means the economy is developing. New Year's resolutions for Asia biggest economies. This is just about, I put it there here because of this biggest economies term. When we have, for example, biggest economy in the world, or this economy is big, it means that its GDP is big. China overtook US as largest global economy. We see those titles all the time, but for now, it's not happened. You know, because US is the first in ranking and China is the second. So that's what they mean, that they meant change places. And it's about Indian economy to contract by almost 10%, according to the World Bank predictions. what they mean by contract. Contract means to decrease, that GDP is expected by World Bank to decrease. By the way, those titles, they often use some very sophisticated terms because they have to write those media, they have to write about those topics like every day. And they start to using very sophisticated words. Like I have to Google and translate them all the time because they're very different adjectives to make it more diverse probably in the media. Okay, and here is this ranking again. And we see that United States is the first, China is the second in their GDP. And the question is to you, does this data imply that people in the US live like the best, richest, and the most prosperous in the world?
No.
Yeah. No, of course not. And also doesn't mean that people in China obviously do not live second best and richest in the world. Here's why. There are some shortcomings of GDP measure, at least when you want to somehow estimate how well people are doing. First of all, this measure of GDP depends on population size because every person in the country is producing something, or almost every person or most people in the country producing something. For example, in China, we have more than 1 billion people. And when more than 1 billion people producing something, of course, GDP will be big just because of this, at least. It may be both, but at least because of the population size, GDP will grow. GDP will be big. When we try to estimate the well-being, also we need to account for the price levels. For example, if I have the same salary as my friend, but in my country, for example, loaf of bread is 10 rubles, and in her country it's like $5. Of course, those are completely different levels of life. So you cannot judge just because of the income side. You also should take a look at the price level. And also, when we talk about the GDP growth, it does not always reflect the improvement of economic conditions. There could be other reasons. So GDP may grow, but people do not live better, actually. One way to overcome those shortcomings could be GDP per capita. GDP per capita measure is just GDP divided by number of people in the country. Okay, what countries would you expect to see if we had a ranking of GDP per capita list? Who do you think would be at the top? What country?
I would say European countries and Japan, maybe.
Yeah, something like this probably. Where do you think is Russia?
Qatar, I think Qatar, and I think Luxembourg. I expect to see countries with basically smaller population and countries probably with countries that are oil rich or have maybe some form of gross domestic capital, like high domestic capital income, but they have smaller populations. So the Arab countries, we have Switzerland and Luxembourg.
For some reason, everyone is voting for Switzerland. Let's check. By the way, where do you think Russia would be in this rating? Russia was like top 11 economy according to the previous ranking.
Not in the top, probably.
Yeah, Russia. Here is what we have according to Wikipedia, because there are different rankings according to different approaches, but in general, the top 10 are approximately the same everywhere. So you can see that in this ranking, these are some old data for Monaco and Liechtenstein. Here is Qatar. Indeed, according to some ratings, as Kenneth mentioned, Qatar was indeed the first one. Switzerland is also quite high. And Russia, according to this World Bank data, is on the position 63, which is, as you see, much different from its position in just GDP, total GDP. Another way to account for the difference could be using the consumer price index. And consumer price index is different for different countries. It's different for could be different even within the same country. Even so, there is some official consumer price index everywhere. So it's some kind of a weighted average price of some representative market basket of consumer goods and services. For example, if we consider that an average person in our country, for example, buys, I don't know, 20 loaves of bread in a month, or I don't know, it's probably measured in year terms. Yeah. Oh no, we only day terms. I don't know. I'm not sure actually. So we, for example, buy this much bread in this period of time, this much milk. We spend this much on medicine. We spend this much on metro, a taxi, or just our own car. Or we spend this much on communication, so on. And all this is calculated and is stated as some representative spending of an average person in a country, for example. And it helps to measure the differences between people living in different regions or in different countries, and so on. And here, how we come to the inflation definition. Inflation is about the general change in price level in some region or some period of time. And it could be the case. So, for example, if prices are growing, this is inflation. If prices are declining, it also happens. It could be referred as deflation or negative inflation. And also, as for every complicated measure, there could be several ways to measure inflation, but one of them would be via this CPI, Consumer Price Index. And this could be just some percentage change over a year, for example, of the CPI. This is how inflation rate could be calculated via CPI. And here is an example of Indonesia. Media, it states this consumer price index of Indonesia is lowest in 2 decades. So CPI is also some term you can often face in mass media. And there is inflation, and there is such thing as hyperinflation. Hyperinflation happens when inflation is very, very high, and usually it's growing with acceleration. It's growing faster and faster. And it happens relatively rare, and it's quite a devastating event for the economy. And here you can see some examples. For example, after the First World War in the 20th century, there were, I believe it's about probably 1920. Here you can see the years. In Germany, there was hyperinflation, and you can see how a price level of gold changed over 3 years, a little bit more than 3 years. So I'm not even sure how much percent it is. And you see that, for example, less than 1 month, between November 5th and November 30th, there was a 10-fold increase in price. Of course, they could use something else, not only gold, but still, I'm sure the price difference will be different and its dynamics as well. And here, another popular example of hyperinflation it's quite recent. It happened in Zimbabwe in 2007, 2009. And as you see, and what happens when hyperinflation happens? Central bank usually has to issue more and more money. They started printing money, and the prices are rising. And you print more money, the price is rising even more in case of hyperinflation. And at some point, Zimbabwe Central Bank printed a banknote of the nominal of $100 trillion. So it's hard even to calculate how many zeros are here. It's probably 12. Oh, no, 12, 14. So now they somehow resolved this crisis. So as I know, if I'm not mistaken, they just switched to the American dollars. So now official currency of Zimbabwe is American dollar, if I'm not mistaken. But still, you can buy in the internet this banknote just, just for memory. Or if you like such unusual things, you can still find it on the internet. I even tried it. Its price was about 1,000 rubles when I checked it a couple of years ago. So it's quite $100 trillion is not that much, as you would think. Okay. Another approach to overcome those shortcomings of just GDP measure could be a comparing nominal and real GDP. For example, it could be the case, assume there is inflation in a country. Of course, I'm not sure, maybe it's not so clear, but it may be the case that economic growth just happened because we have some inflation. For example, we have 5% inflation, it's normal. Nothing catastrophic, but still we can see some GDP change just because of this inflation. And in this case, GDP growth, it's not caused by some real improvement of life condition of the economy. It's just because of the inflation. And to account for this, there is a measure called real GDP. So nominal GDP is just a simple GDP we just discussed without any additional adjustment. And if we want to account for the inflation, we would use a real GDP. So real GDP is just GDP, but without accounting for inflation. And as you remember, inflation is measured over some period of time. And so if we are talking about the real GDP, then we should mention some point in time where we start neglecting the inflation. For example, it could be real GDP. On this picture, you can see International Monetary Fund data. If I'm not mistaken, for some reason, I forgot to write down the year it counted from. It's real GDP growth, so it doesn't really matter. So here on this map, you can see real GDP growth for different countries, and in year 2020. And as you can see, it was quite bad for almost every country. And this is quite, you could expect this, right? Because it was a pandemic and most countries' economies suffered quite a lot. But according to the same organization, we have quite a good prediction for the next year, for this year actually, for the year which is ahead. Everyone except Venezuela, I guess. Sorry for them. Okay, here we come for the exchange rate. Exchange rate is a term which is probably familiar to everyone. It's about currency. It's about how much of one currency you can get for another currency. And for example, exchange rate of US dollar to Russian ruble of 70 means that you can buy 1 USD for 70 rubles. And yeah, and in this example, the question to you, in this example, what would be the exchange rate of ruble to USD? It's quite easy, I think. Yeah, it's one. Thank you, everyone. Yeah, it's 1/70. So if we can buy one unit of one currency for 70 units of another currency, that one versa, it would be 1/70, of course. And oh, someone likes to be very precise, like Dmitry. Another question, more complicated. For example, assume that X to Z exchange rate is 60 and Y to Z exchange rate is 4. And then what would be the exchange rate of X to Y? Here is something in the chart. 15. Yeah, it was not so tricky after all. Yeah, that's right. It's 15. So the trick was that someone could start multiplying it. And the tricky thing is to understand if you need to multiply those numbers or you need to divide one to another, because it's not always clear. So be careful with the statement of which is which to which. So it could be Y to Z or it could be Z to Y. This would be different exchange rates. Okay, I think it's clear about the calculation of the exchange rate. And now let's talk about the exchange rate regime. Exchange rate regime is about how central banks or monetary authority, if it's not central bank, manage the currency exchange rate, meaning the national currency to other foreign currencies. There are two major types of the exchange rate regimes. It could be a fixed exchange rate regime. It could be free floating exchange rate regime. Let's start with the free floating exchange rate regime because it's quite more, it's simpler. Just let's start with this. Floating exchange rate regime is when actually monetary authority do nothing. Actually, they just don't intervene, and the exchange rate is defined only by the market. So you remember we discussed the order book. So the same order book could exist for this is example for some random asset, but this could be the same for currencies. For example, this would be I don't know, if we're talking about USD to ruble, it could be, I don't know, here it would be 74, 75, 76, 77, and here it would be 73, 72, 71, and so on. And until there is some spread between asks and bids, trade would not happen. And if there would be some market movement, this balance would go up or down. So in the free floating exchange rate regime, the final price is defined by the balance between supply to the currency and demand to of this currency. And examples of a completely floating exchange rate regime are United States, it's Eurozone countries, United Kingdom, Russia, also very, very close to this, but it has some differences. We will talk about it later. And officially, yes, officially Russia has a floating exchange rate regime. Now let's talk about fixed exchange rate regime. fixed exchange rate regime, as you can guess from its name, it's when your national currency is strictly linked to some foreign currency or several foreign currencies. For example, it could be, I don't know, fixed to 1%, or not 50%, for example, exchange rate to euro and 50% exchange rate to dollar. There are two ways how the government can control the exchange rate. The first one would be by market interventions. And market interventions means that central bank makes some operations on the open market which affect this level, right? So if in the free floating, this order book was just how it was, so everyone does on the market what they want, and in fixed exchange rate regime, government from time to time comes to this market and just start to move the market, by some operations. For example, if the currency started to weaken, the central bank may start buying it. And if the currency, for example, getting too strong, the central bank may actively, it's a mistype. If the currency is too strong, then central bank would probably sell it. So I'll correct this in the slides. And that's actually the reason why the government should maintain the foreign exchange reserve if they want to control the exchange rate. Because otherwise, for example, let's assume that Russian central bank would be willing to control the Russian ruble, then how would they find a foreign currency to buy rubles when it's weakening? So they must have some reserve in foreign currency to do so. Otherwise, they would not be able to control the exchange rate. And also it could be even more, it could be very strict. I don't know even such examples, maybe they probably exist somewhere, but the government may also say, okay, by law, it's forbidden anywhere to, to sell or buy our currency at any other rate than we stated. It could be like that. And example of fixed exchange rate is Saudi Arabia. They fixed the exchange rate to the US dollars many, many years ago. It's since 1986, it's 3.75 US dollar to Saudi Real. Okay, and let's consider now Russian example, because in many countries there could be like a lot of some intermediate regimes between completely free floating exchange rate and fixed exchange rate. Russia is not probably like super intermediate example, but still let's consider it as an example of some intermediate state. Important thing is that Russia changed its exchange rate regime in 2014 when we had a ruble economic crisis, because it could not support the ruble anymore. So before November 2014, we have a question in the chat. Why one country may need to have fixed rate US dollar to have opportunity to print money? No, just because you fixed your currency rate to some other currency doesn't mean that you have, you may affect it somehow. It doesn't mean that you can use a payment system. It doesn't mean you can print money. It just probably, to show the world that your government guarantees that your exchange rate, it will always be stable. So, because, for example, when you invest in other countries, you may be worried, okay, what if exchange rate changes, for example, and according to my national currency, this currency I invested in will like change significantly and I'll lose half of my money. And this government will say, okay, that's okay, we guarantee that our exchange rate is fixed. So this could be one opportunity. It also has some disadvantages. because when the currency rate changes on the market, there are usually some reasons behind that, and it may be the case that some strong fixed exchange rate is not optimal to the economy itself on the one hand. I probably not able to go like deep into details because what exactly affects the exchange rate and economy and so on is quite a complicated question. But both regimes, they have their pros and cons. Did I answer your question, Valentin? Okay, I hope I did. Oh, okay, yes. Okay, as Russian exchange rate regime. Before November 2014, we had so-called currency corridor. There was some level of the exchange rate of rubles, and our central bank stated, okay, we do not intervene until it's like from here to here. Like there was some lower limit defined and some upper limit defined for the ruble exchange rate, and exchange rate was defined not to just one currency like USD or euro. It was defined by some basket of USD and euro. So it was in this formula, it was 55% USD and 45% of euro exchange rate. And if these metrics would go out from the bounds of this currency corridor, then the central bank would come to the open market and make an intervention and move the market back to the corridor. And as for October 2014, these corridor limits were like stated in this range on the slide. Around it was 9 rubles wide. And in November 2014, there was a crisis coming to Russia and to ruble specifically. So Russian Central Bank decided to change the exchange rate regime, and it announced it officially to be free floating, and it is still officially free floating, and it substantially acts like free floating, but there is one nuance. Government does not intervene ruble because of its level relative to other currencies, but Russian government intervenes to the currency market depending on the oil price. So if the price is higher than some cutoff price, which is defined by the government in advance, so for the last year it was around $42 per barrel of oil, and as soon as their oil price is higher than this cutoff price, the currency started to buy a foreign currency. And as soon as the price of oil is lower than this cutoff price, our government would be selling the foreign currency for rubles. So this approach is called in Russia budget rule, and as you see, it can affect ruble because as soon as our government makes some operations of huge volume on the market, of course, it will move the market and affect the exchange rates. And this budget rule also affects exchange rates. So, any ideas why Russia would need this budget rule? How do you think? Any ideas?
Well, I think that in case of high oil price, we have a big income of currency in our country, in Russia, right? So it would accelerate inflation and will make the prices bigger. So in order to prevent it, this extra money is spent for buying this currency.
No, not exactly. Any other ideas?
Maybe oil price changes too fast and just for currency exchange rate not to change so fast, they have to do something. I don't know.
That's a right direction of thinking. Actually, yes, you know that Russia is an oil-dependent country, right? And our economy depends on oil price quite a lot. So you may have heard that, for example, when oil starts to rise in price, the Russian ruble also becomes stronger. And when oil price falls, the Russian ruble becomes weaker because, you know, when there is no oil, you know, Russia would not be doing well. Can we have, okay, let me finish. And as Anna was correctly suggesting, that when oil price is high, ruble started to grow, to strengthen. And when the government buying foreign currency, it weakens the ruble, so it's not growing so fast, and vice versa. When oil is falling in price, the ruble also falling in price. And if the government starting to sell foreign currency, it's actually buying the rubles. So it's artificially increase the demand for rubles, and the ruble is not falling so fast. So yes, indeed, the budget rule is needed to prevent those this high volatility, this high changes of the currency rate. I see the question: can we get off the oil needle with such a regime? By such a regime, you mean this exchange rate regime?
I mean dependence on oil.
This is I don't know. I don't think this is a good thing. I mean, commonly it's you know, it's suggested that being dependent on one thing in the economy is not good. Can we get off or not? I don't know. It's a complicated question. I hope so, of course. Many countries like live without oil. So, but will we do it or not? I don't know. It's a philosophical question, political, economical. I hope so, but I don't know. Okay. Let's continue. You probably heard that many central banks, and including Central Bank of Russia, define their official interest rate, or no, sorry, not interest rate, exchange rate. So you can hear everywhere exchange rate of Central Bank of Russia, for example, or exchange rate of Central Bank of, I don't know, other countries. You probably heard of it, right? So what it means, because sometimes people are confused with this name, that this is exchange rate, so probably I can exchange money for it. So spoiler, this is not the case. Each central bank has its own way to define its official exchange rate. So I can tell about the Central Bank of Russia. For example, Central Bank of Russia announced its official, let's consider example, USD dollar ruble official exchange rate. It goes for the market today in the morning and measures what is their average trade price from 10 a.m. to 11:30 a.m. on the market, on the exchange. And then central bank calculates its average price, and it states it as an official exchange rate for tomorrow. So tomorrow it will be exchange rate which was defined a day before. So there is quite a lag, and sometimes it could be quite a big difference between the exchange rate official stated by Central Bank of Russia and actual market exchange rate. So the important thing I want you to know, to understand, that you cannot buy currency at the central bank's exchange rate. It's just some indicator, to for banks, for for many purposes. But if central bank states some level of the exchange rate, it doesn't mean that you can buy anywhere on the market currency at such price. So it does not exactly reflect the today's state of the market. And sometimes it may vary significantly, especially when the exchange rate is changing rapidly. It could be the case. I don't know, it may differ, like in the worst days, maybe 10% difference or something like this. So be careful. Now, the question, what affects exchange rates? It's a complicated question, really. Many factors affect different exchange rates. Different economies act for different rules. So here you can see picture exactly that in 2014, the US dollar started to grow rapidly to the Russian ruble. So it actually doubled, more than doubled in price on those 6 years. And even in 1 year, it wasn't doubled in price. So let's consider example of ruble. I see question. Yeah, the question, does each bank set its own rate independently of the central bank rate? Yes, of course, yes. Because actually in banks, the level of exchange rate is more representative than in central bank, because central banks just stated it's not trading it. The banks trading the exchange rate they set. If you come to the bank, for example, Sberbank or Citibank, and they state some exchange rate, you can buy or sell the currency at this rate. And they are not interested in setting, some rate from yesterday, because otherwise they may risk a lot that something changed and they're not trading in the market and they could lose money on this. So yes, exchange rate is set independently. Why we don't get actual exchange rates? That's a good question. In central banks, because if you mean actual exchange rate, which is stated for central bank, because sometimes central bank needs to provide its official rate a little bit in advance. For example, I can give you example. For example, many big companies, they may take loans or convert their loans, for example, from USD to ruble, and they don't care about what's going in the market. They want some predictability. They would not agree, just to point in some second and say, okay, just convert it in whatever it will be, I don't know, tomorrow, 12:15. They want some predictability, and that's why it's useful to have some indicator from the market. And central banks play this exact role. It just gives some predictability for tomorrow. It's just not a matter of economics, it's more like the matter of predictability and trust. That many companies, they would agree to convert their money tomorrow, but some rate they would prefer to know today. But for banks, it's not always profitable to do so, and this is a problem within the bank. So when I worked in Sberbank, I was doing exactly the exchange rate risks department. And this is a problem, yes, that many people or companies, they come and they say, okay, we want to convert our money at central bank rate. And this may be not completely profitable for the bank itself. And why we don't get actual exchange rates from bank? Actually, on average, we do, but they usually take a big commission, from above and from below. So if we want to buy, they'll sell it as more expensive than it is on the market, and then if we want to sell, they'll buy it cheaper than it is in the market. But on average, we will get the, more or less market level. Did I answer your question? Say Pavan. Okay, I hope I did. Okay, so let's consider example of ruble. Even for ruble, it's still a complicated question, what exactly affects its exchange rate to foreign currencies, but some major factors commonly accepted are known. So first of all, as we already discussed, the Russian economy is very dependent on oil. So ruble depends on oil price. So if oil price goes up, everyone started believing in Russian economy and ruble, and Russian ruble always also gets stronger, and vice versa. And also, unfortunately, as you know, recently, and not only recently, Russia is exposed to many political risks. So some conflicts, some problems, and there are some sanctions, and foreign investor maybe not willing, maybe not sure about the stability about Russia. And they may be not willing to keep their money in Russia. So they may decide, for example, okay, I'll take my money to my country or invest in another country. But to do so, they usually need first to get rid of their rubles they already invested in Russia and convert them to, for example, to dollars. And they will go to the market and they will start selling rubles on the market, and of course the ruble will drop after this. Is it clear, this mechanism? That if foreign investors are not sure about the future of Russia and Russian ruble, they may be willing to get rid of the rubles and they go on the market, and this will move ruble price down relative to the US dollars. Or in our terms, it will increase the price of dollars, euro, etc. Any questions? If it's not clear, please ask. Okay, here I see some question. Quite clear. Okay, thank you, Valentin. Also, there is a connection between level of interest rates and the currency exchange rate. Interest rates is also an important feature of the economy. We are going to talk about it right on the next slide, or almost the next slide. And there is connection of interest rate levels and the strength of the national currency. And the connection is not simple. Generally, if there is an increase in interest rates levels, then the national currency gets stronger. But this is quite a simplified explanation. It could not be that simple. So in general, it's like this, but not always. Also, if the government intervenes the open market, then of course it's also affect exchange rate. And also there are many other factors. Some of them we can know, some of them we cannot know. Some of them probably psychological, when there is some panic or something. So that's basically it for the ruble case. And the important thing that so far there is a lot of uncertainty always about the exchange rate. So no one knows where the ruble or dollar or something else will be tomorrow. So there is so far no way to predict exchange rates and make money on it on a regular basis. This is something I want to devote a separate slide because, I'm not sure about right now, but a couple of years ago, it was quite popular in Russia, such things. So far, there is no like legal way to found and predict exchange rate to make some extra money on it, like all the time, you know, like with stability. So I don't know as for other countries, but in Russia, I saw it many times, some advertising like, we will teach you how to earn on Forex, or something like, give us your money and we will invest in Forex and you'll get rich. Please do not ever believe this. This is not, there could be no guarantees. These are probably either frauds or just some people who try to lie to you. So there are, of course, chances of making money off exchange rates, but they are like in casino. So if someone could predict it, it would be like the richest person in the world, but still no progress in this. So you can do it for fun, but if someone is trying to give you any guarantees, so they are lying. So that's it on this part. Okay, the last topic of this broader topic of financial system, those are interest rate. Interest rates are very important for the economy, and if we're talking about this in general, then interest rate is the amount of money, of so-called interest, which you pay over some period as a proportion of the money that you borrowed or lent in the bank. For example, you may place a deposit in a bank and they will return you money with a 5% interest, for example. It means that you'll get 5% more if you invest in 1 year than you initially gave to the bank. And there are also many things which affects interest rates. First of all, the currency. In different currencies, it's different interest rates. Also, it depends on time period, which money is borrowed for. For example, if you borrow money for 1 week, it's one interest rate. If you borrow money for 1 year, it's another interest rate, and so on. Also, if we're talking about some specific deal, like loan, especially loan, your interest rate will also depend on risk factors. For example, if you have a very bad loan payoff history, you'll probably get a higher interest rate because this is a risk for a bank. This is not only about payoff history, there could be other risks, and bank or someone else or some other counterparty, they can estimate their risk and set interest rate in accordance to that. And there could be also some internal reasons of your counterparty. If it's a bank, for example, the bank can set very high deposit interest rate, higher than market, higher than everyone else. And it could be just because, for example, it's experiencing a bank run. Everyone wants to take money from this bank and they just need money as soon as possible. I mean, cash. They need cash as soon as possible and they just set very high interest rate just to survive. But this is more like an exception. Any question?
I have a question about exchange rate. Like, for example, bank starts opens his doors today. He has yesterday's exchange rate, and how bank decide how it count what exchange rate is going to be today in this bank.
They just every bank, they also have a trading department. They have access to market. They can see the market level, and the market level is basically what's going on in exchange. Exchange, I mean, like a trading place, a marketplace we discussed previously, like Moscow Exchange or New York Exchange. They can look what's going on the market, and they will see some current level, and they will just set their exchange rate in according to this. For example, I think it's okay if I write here. For example, morning. Maybe not morning, but okay, bank goes to the market. And for example, it can see that the current trading level of US dollars according to relative to the ruble is like this, right? On this picture. So bank sees this and it says, okay, the market level is like this, but I want to earn something. So if you want, he tells us, if you want to buy dollars, your price is like this, for example, 75. This is like, I don't know, this is crazy, but still in Russia, unfortunately, many banks, including Sberbank, they do so, such a big difference. And he said, the bank may say, if you want to buy, it's 75. If you want to sell, it's, for example, I don't know, sorry. 72, for example. So that's how they define. So this is the market, and they also want to have some premium. From here, it's about 1 ruble. Here, it will be around 2 rubles. And here is some market level somewhere in between. And that's how the bank may define the level. Is it clear?
Yes, but does this exchange market rate depend on the what bank, on what prices bank buy and sell some currency? Like, I do not quite understand from what source this exchange market rate are coming. Like, isn't it from the some banks exchange rates?
Just for example, what's you mean what's going on the market? Why there is even some price when the bank looks at it initially?
Yeah, like from where this price is coming on the market.
You know, there is many people who has access to the exchange. It could be companies like banks who, for example, need foreign currency or rubles for their internal needs. It could be just some companies, for example, who works on export or on import. They need to convert currency all the time. It could be some individuals who, who already know all about financial products and they just don't want, to participate in this robbery of 75 and 72, and they just know that they can buy currency on the market, with very low commission. Or, I mean, it could be many different participants, companies, banks, other financial companies, it could be government. They all just connect to the exchange and send their orders, and the trade is going on if some orders are matching. Is it clear?
Yeah, thank you.
So, and every person who has a connection, even if you don't trade, you can see what was the last trade, for example. You can see the current, you don't have to trade to see this number. You may just come to look and to come back and set the level. Okay, I believe there was some question in the chart, probably right. In airports, the price difference is even more extreme. Yeah, in airports, it's like, because you usually have no choice if you're exchanging your money in the airport. And they're just using it. The same actually as major banks like Sberbank, they're using there everywhere, and you probably will be very uncomfortable, to go any other place. So they're using it and they are setting very high commissions, which is not like it's unfair because, it's they have this right, but this is harsh. Okay. Let's move forward. we stopped here, I believe. So there could be differences. For example, we can talk about interest rate when we make some deal, for example, take a loan or provide a deposit, but as well it could be we could be talking of interest rates on a macro level. For example, when we're talking about some country and we're talking that interest rate in this country is like this, it could be referred, it usually refers to some average level of interest rates in this country. And what defines this average level of interest rates? It's a so-called central bank key rate. Key rate is something that central bank is explicitly setting like in Russia, it's like about every month, I believe. It depends, they change schedule all the time, so I don't remember. And by the way, who knows what is the current level of key interest rate in Russia? Please type it in the chat while I am talking. So what is this interest rate which is set by the central bank? Is not just some random indicator which means nothing. It's a level of, it's an interest rate actually in which banks may deposit money in a central bank and take a loan from a central bank itself. So this is the instrument how the central bank translate this level of interest rate to the banks, to the commercial banks. And you know, commercial banks, they are everywhere, they affect everything. So that's essentially how central bank is translating its key rate to the economy. The right answer of the Russian key interest rate for now is 4.25. Yeah, that's correct. For now, yeah, it's 4.25% for Russia. And for United States, I believe it's a little bit higher than 0, maybe like 0.25. And for Europe, I'm not sure, I need to check it, but I believe it's negative. Okay. Also, what's important is that key rate affects inflation and interest rate level affects inflation in the country. The connection is quite complex. I know it is a fact. I'm probably not ready to explain this in details, but why central bank is doing what it's doing, it's because it needs to affect inflation somehow, and it chooses interest rates so to affect inflation the best it can. The last point is quite interesting that from recent times, interest rates can be negative. So now many countries have negative interest rates. Like for, sorry. And very important thing, I'm sure you'll forget about it probably if you never heard of it, but I'll remind you again. Interest rates are always stated in annual terms. What does it mean? It means, for example, if you deposit $100 for 1 week for 5%, this is very high for US dollars, but still, let's assume. Please type in the chat, how much do you think you'll get back in a week? Obviously, you will get back your money of $100. I see one answer. Yeah, it's probably correct. Yes, you're right. So the percent the important thing that it will not be $5. So it will not be 5%. It will be $5. sorry, 5% multiplied by the initial amount, which is indeed $5, multiplied by the term you're depositing your money for. It's 7 days out of 365. Usually it works like this. So, and this will probably be something like this, if to believe people in the chat. And I believe this sounds like very truthworthy. So that's why when you said the interest rate is this much percent, it doesn't mean that this much percent is exactly how you get back after you return your deposit. So you should always remember this. Okay, and probably this is the last slide with some content. You can see examples from the media. For example, Russian central bank holds benchmark interest rate at 4.25. This you see, they even call it benchmark interest rate. It means that it defines the benchmark for the whole economy. For example, Indonesia, Philippines hold key rates. It just means they kept key rates as they were previously, and the European Central Bank keeps interest rate at 0. So 0 is like already quite a problem for the economy, but still there are 0 interest rates. And here on CNN, we can even see that Bank of Japan adopts negative interest rates. It's quite an old title, I believe, but still there were many examples in Europe, Japan, Switzerland, when they had negative interest rates. So this could be the case. So here's a little bit about your home assignment. The home assignment is like the following. You need to find some article on one of the terms that we just discussed on this topic and retell it in Canvas in your own words in a very, very short paragraph. And please don't forget to provide the link to official original article. You can find something like this just by Googling, so you can use any source you want. But if you want, if you prefer some, I don't know, some more fundamental sources, here are some examples which are like world recognized financial media, which you can use. This presentation is in Canvas. So, any questions?
The deadline for the assignment?
The deadline for the assignment is in 1 week, but I believe I made it available a little bit more. So, but okay. The deadline is in 1 week. Any other question? Okay, then thank you very much. See you tomorrow. For those of you who will be there. Thank you.
Thank you.
Thank you.
Thank you.
Thank you.
Goodbye.